Hi, my name is Jim Penna, and I'm the Manager of Retirement Services here at VectorVest, and I thank you for taking the time to join me. Today I'm here to talk about two things: the flood of retirement articles and information that overwhelm us every day, and the VectorVest Ultimate Retirement Solution. On my iPhone, I have all of the different news feeds where you can choose different categories. Of course, I have my sports and my business feeds, but I also have the retirement category chosen, and I receive dozens of articles each week. Now, that constant flow of information sometimes provides some helpful advice, but much of it addresses issues that we cannot control or ask questions that we simply cannot answer. And almost none of them provide a realistic solution. Now, one example of many is an article titled, "Opinion, Baby Boomers Commit the 7 Deadly Sins of Retirement Planning." It was written by a gentleman named Brett Aarons and published by MarketWatch. It's a summary based on a survey of baby boomers and lists the 7 things not to do. So I'm going to walk through them. I'll start with sins 1 and 2 as they make pretty much the same point, so they're kind of related here. Number 1 was not saving enough money or anything. And so yeah, it is the most obvious, but it's worth repeating, according to Mr. Aarons, that an astonishing 23% of baby boomers have no retirement savings and never did. And sin number 2 said even if you did save, many baby boomers then made the mistake of draining that retirement savings. So if you drain your retirement savings out of desperation or an emergency that might come up, that's one thing. You do what you have to do. But if you drained your retirement savings to go buy a new Tesla, that's on you. Sin number 3 is not calculating a retirement savings goal, and that's an important one, and I'm going to come back to that one. It's a lot harder, Mr. Aarons writes, to save enough for retirement if you haven't at first tried to work out how much that's supposed to be. But again, this is one of those questions we can't answer. But I'm going to come back to number 3. Sin number 4 and number 5 are also related, and they talk about underestimating health costs and underestimating long-term care costs. Now, I believe you should try to calculate those things out, and you should have a plan. However, we don't know, again, answers to many of those questions. How long am I going to live? How much am I going to need to spend in health care when I retire? So these are very difficult questions to answer, which brings us to sin number 6, which is mishandling your retirement date. Now, on one hand, some people have been forced to postpone retirement because they couldn't afford it, according to Mr. Aarons in the study. Now, if you're one of those folks and you need to continue to work, then you're going to have to continue to work. But again, we're going to address that in the Ultimate Retirement Solution. But the goal here is for you to be able to make that decision. And then finally, sin number 7. And this is an obvious one, and I'll spend just a minute here. Sin number 7 is not setting your affairs in order. I can tell you from personal experience, I will not bore you with the details, but if you have parents or you are a parent, for your children's sake, make sure you get your affairs in order before it's too late. Now, all these articles and stories and questions, they all lead back to this question in one form or another, and that is, how do I keep from running out of money in retirement? Now, after many conversations with the founder of VectorVest, Dr. Bartolito, we determined that the answer to that question is just keep making more money, or what we also call the Ultimate Retirement Solution. Here at VectorVest, we define a secure retirement as one in which you have enough income to live the life you desire, where work is optional and retirement is affordable. Now, we achieve that goal by employing 3 very specific core strategies. Number 1 is capital appreciation. What we mean by capital appreciation is growing that portion of your retirement nest egg that you allocate to the equity markets. So what we do simply is look for high quality, safe stocks that are rising in price so that we can grow our portfolio. Now, we also talk about income. The second core strategy is generating a safe, steady flow of income as well. And then finally, the third portion is capital preservation, and in my opinion, perhaps the most important part of our ultimate retirement solution. Let's begin with capital appreciation. When we find the proper stock, the safe, quality stock that's rising in price in a rising market, these are the type of stocks we're looking to populate our retirement portfolio with. Visa is one example. This is a 5-year look at a chart of Visa. We see the price of the stock obviously rising, and down below is the earnings per share as calculated in the VectorVest program. Understand it's not a coincidence that the price of the stock continues to move in that lower left to upper right pattern the same way that earnings per share do as well. This is the kind of stock we're looking to fill our portfolio with. Perhaps my favorite stock in the VectorVest program, HEI. Again, that nice steady move to the upside with growing earnings. PGR is another example. Using the Ultimate Retirement Solution strategies, these are the kind of stocks that populate our portfolios. We use an indicator called relative safety. or an indicator of risk. It's defined as the consistency and predictability of financial performance. And I often say, what two better adjectives can you use than consistent and predictable to describe the type of stocks that reside in your retirement portfolio? What goes into that data are things like earnings consistency, company size, price behavior, business longevity, dividend history, and debt to equity ratio. So when we check all those boxes and we build a portfolio with stocks that meet this criteria, what we're able to do is see a portfolio and an equity curve over roughly a 10-year period here. As we see in long-term winners, we chose high relative safety stocks where we're up over 21%. That doesn't include any dividends. It also doesn't include any defense techniques you might use in down markets. Pretty impressive return for our capital appreciation portion of our portfolio. Next is income. When we talk about income, we start with dividends. And Dr. DeLito has written in his book, Stock Strategy and Common Sense, that the best of all worlds is collecting dividend checks while the prices of your stocks go up. This comes from finding solid growth stocks that pay dividends. VectorVest is ideally suited to find these babies, Dr. D wrote. There are characteristics of quality dividend growth payers that we follow. Number one is the earnings growth rate. Very important, because what good is the dividend yield if the company can't continue to pay it? And they're not going to be able to pay it if their earnings aren't growing. We then look at the dividend growth rate, because not only do we want steady payment, we want these growth payments from these dividends to keep generating that steady income. And finally, dividend safety. We don't just go out and chase the highest yields, we want the safest yields as well. Now, when you apply that strategy in our dividend portfolio, what we find are stocks like Next Era. Here I have the dividends as well as the earnings per share on the subgraph. This is a 10-year look back, and if you follow that, what I like to call the golden staircase there. Next Era is a company that's not only paid their dividends year over year for at least 10 years and longer actually, but has grown those dividends. And this is what we mean by dividend growth payers. Our process finds stocks like American Water Works, Lockheed Martin, and you can see again the common graph patterns and the commonalities here in these stocks. Alliant Energy is another one that we have in our model portfolio, continuously not only paying but growing their dividends. When you apply the strategy and you use the VectorVest trading plan using the Profit Locker Pro as an exit strategy and management for our portfolio, here we have a portfolio about 6.5 years or so, up over 107% using the Profit Locker Pro trading plan. That's 16.5%. Now, what that does not include, is the nearly $30,000 we've generated in dividend payout. And this is as of 6/29/19. So add another $30,000 to this, and you're looking at an annualized rate of return of over 20% per year. Now, that also does not include the power of reinvesting those dividends, and it also doesn't include, again, any portfolio hedging that we might do in down markets. Next, we have income part two, the covered call. For those who are not familiar with covered calls, you should be. If you're managing and building your own retirement portfolio, the definition by a gentleman named Lee Lowell, a former trader in the option pits, wrote a book called Get Rich with Options. And he gave us what I think is the most telling, most basic definition of what a covered call is. And he said, there are other traders out there who will give you money today for the right to take your stock away from you if it reaches a much higher price. He goes on to say it's such a great way for padding your bank account. I still don't understand why investors aren't taking advantage of it. And you should be as well. A quick look at what a covered call does, the anatomy of a covered call, if you will. You go out and you buy 100 shares of XYZ at $60 per share. You can then sell a covered call. In other words, you sell the right for someone to take your stock away at a higher price, and you get paid $2. What that does is leave you with a cost basis of XYZ stock of $58 per share, not including commissions for our demonstration here. Now, what happens once we do that? At expiration, roughly 45 days later, if XYZ stock is above $62.50, they're going to take the stock away. Someone else is going to take away the stock. Remember, we sold them the right to do that, which is fine, because it's at a higher price than where we purchased it. Not only that, we get to keep the $2 per share that we sold the call for, which gives us $4.50 profit, or 7.7% return in this theoretical example here, over just 45 days. Now, what if XYZ is below $62.50 at expiration? Well, remember, you're long 100 shares, your cost basis is now $58 per share, or just over 3% lower than what you paid. So you've got that built-in cushion, which is great to have. Finally, if XYZ does fall below 58, yes, losses will occur, and that's where our ultimate retirement solution plan comes into place and we minimize and mitigate those losses as we go through. So the covered call is a great way to generate a safe, steady income. Finally, and most importantly, in my opinion, is capital preservation. I was able to find a quote from Mr. Mark Twain that it was the perfect segue into why preservation of capital, protecting, insuring your portfolio is so important. He said, don't just sit there and worry. Be proactive. Do something about anything that's worrying you so that you can gain information, focus, and control over the situation. I've suffered a great many catastrophes in my life. Most of them never happened. And I just found that quote and I thought it was the perfect segue into the power that you have in hedging and insuring your portfolio. Let's take a look at a quick example. This is the S&P 500 ETF SPY. It tracks the S&P 500. What we're looking at here is an extreme example, I understand, but I want to walk through it anyway. Back in October of 2018, the VectorVest program recognized a confirmed down call in the market. And I want to show you how you could live through this mayhem that we saw without worrying about it because you were proactive, and this is what we do. Again, on October the 4th, we got a confirmed down call in the VectorVest program. The overall market was in a downtrend, and we needed to be proactive. What do? The next morning, we go out and we buy put options on the SPY. What's a put option? Well, it simply gives you the right to sell SPY at a certain price by a certain date. In this case, we bought the 289 strike when SPY was trading right at 289.89. It cost us $6.04 per share. You buy just 3 contracts at the 289 strike price. It costs you a total of $1,800 to protect this theoretical $100,000 portfolio that we're managing. It's insurance, just like you have home insurance, car insurance, health insurance. That's all this is. At expiration, for this particular theoretical example, would have taken us out to December 21st of 2018. The SPY, which was trading at $290, is now trading at $240 per share. The December 289 strike price put option that we bought is now trading at $45 per share. That's a profit of over $39 per share, or just under $12,000. I'm not saying you would have bought it exactly on the morning of the 5th, although you should have, but you may not have held it all the way to the 21st. But think of it this way. What if I had gotten out around this area here? I still would have profited and mitigated my losses. What about down here? Even in these areas here, I still would have profited from my insurance policy and mitigated that loss in my portfolio. Again, not having to live through those catastrophes. So capital appreciation, an extremely important part of building and managing your retirement portfolio. So again, the ultimate retirement solution, according to Dr. D, it is just keep making more money. So once again, thanks for taking the time to join me today, and we'll see you on the next episode of the Ultimate Retirement Solution.